Hey, hello, everybody. My name is Philip Palumbo. I'm the host of the Palumbo Pulse, where we interview some of the most successful strategists and economists to learn about their perspectives on they view the world and the markets. Today, we have with us Jake Jolly. Jake Jolly is a senior investment strategist at BNY Mellon Investment Management, and he's also a chartered financial analyst. So, Jake, thank you for coming on our show today. We really appreciate it.
Thanks for having me. Happy to be here.
All right, great. So, why don't we first start with talking about the elections and the results of the elections? What is your...
Yeah, well, I'll first sort of hedge my answer by saying that I'm not a political analyst, so I don't spend all day staring at what's going on in Washington, D.C., but I certainly can provide a few sort of takes. We are, less than 24 hours out from polls closing. I think sort of the biggest takeaway thus far has been sort of the quote unquote red wave that was, I think, largely consensus. Sort of wasn't quite as big as expected, right? So I think from sort of the Republican perspective, a bit of underperformance, said the other way, a bit of outperformance on the Democratic side.
Right.
Obviously, sort of sitting where we are right now, the Senate is still up for grabs. I don't think we're going to have a decision or clarity on that in the next couple of days. It's likely going to push into December with a potential runoff in Georgia. But the House, as expected, it looks like it's going to swing Republican, but by a much narrower margin than was projected. So where does this leave us? What does that say about how the market might react? Well, I don't think it changes that much, to be perfectly frank. The expectation was that you were going to have a Democratic president and a Congress controlled by the Republicans. Whatever happens in the Senate, we're still going to have a government that is divided. So from sort of a market's perspective, when we look into 2023, I think expectations about any major legislation next year are very limited. Maybe more critically, though, is, and we'll, I'm sure, get into this in today's discussion, but around, if the economy does enter a recession, what does this mean for fiscal support possibilities next year? And I think, that was always going to be challenging because on the one hand, you have Republicans now taking control of the House, who have linked the high inflation that we're currently experiencing with sort of fiscal overstimulus in the recent past. So there might be, reticence to come to the aid of the economy with fiscal support next year if we do enter sort of a garden variety recession. Whereas on the other side, you have Democrats probably leaning maybe more towards the, the maximum employment side of the Fed's dual mandate. So potentially wanting to provide more support and particularly if unemployment starts to rise considerably next year. So, we'll have to wait and see. This is all tied into an outlook that is still relatively difficult to read. But I think on the whole, the market is still getting sort of that divided government. And to the extent that divided government provides greater clarity into next year, I think that's generally a good thing for the market.
Right. So the key thing is the gridlock really is all about taxes and possibly taxes going up if Democrats were to control the House and the Senate. Do you agree with that?
I do. And, we did have some tax policy changes this year coming through in the Inflation Reduction Act that do take effect. So, the one that I've been looking into is the 1% tax on stock buybacks. So this is an interesting one because it's a relatively, you don't see changes like this too often. And I think the interesting thing is that it does seem, that it is a response to larger buybacks in recent years coming from tech firms. But the interesting thing is that when you actually look at, how much these buybacks represent as total market value, it's still very, very small. And then compare it to the fact that we're talking about a 1% tax. So just in dollar terms, this is not a very large amount. That doesn't mean that companies aren't probably pulling forward some of their buyback activity into this year, trying to get ahead of that tax next year. But yes, I mean, getting back to sort of your question there, Next year, tax policy, I think there's more clarity because you're not likely to see any major pieces of legislation go through.
I agree, which is a good thing. And what that means for our audience and bottom line is for earnings, right? So if taxes were to go up because of policy, that would affect corporate earnings and is a direct correlation with corporate earnings and the overall S&P 500. So that's why that's a concern for us as investors. I want to turn to the economy. So the key thing I find interesting is that the Fed started raising rates back in March for the first time. So we're almost about 7 months into this first initial rate hike. And we all know as investors, economists, that it takes time for that to be felt into the economy. Are you surprised by how tight the job labor market has been and it jolts numbers? And what is your view on that?
Yeah, I think most people have been surprised by how the labor market, not only that it has been, so tight for so long, and just to, define that a bit, the tight labor market is really sort of a combination of very low unemployment, lots of job openings, and the outcome of having that type of a market where the employee has a lot of options, has a lot of ability to move around. Really, the consequence of that is higher wages, right? So this is why when Chair Powell is giving his press conferences, he's oftentimes talking about the labor market and how extremely tight that labor market is.
Right.
And this, is coming out of the COVID rebound. Obviously, the labor market cracked very aggressively during COVID, but also bounced back very strongly during the recovery in the last 2 years. And now we're sitting at a place where I think, given how much tightening we've seen, most people are surprised that we haven't seen the labor market loosen up. So, why do we say tight versus loose? Well, really, it's about this supply-demand imbalance, right? The demand for labor is still very high. The supply has been low, so the price has had to go up to basically balance the labor market. And what the Fed is trying to do, or accomplish through raising interest rates, is try to cool demand, right? It doesn't have very much control on trying to raise the supply of labor, but it can, through raising interest rates, tightening financial conditions, it's able to reduce aggregate demand so that labor supply and demand come more into line, which ultimately should result in a cooling wage growth environment. Now, why is wage growth such a concern? Well, right now, broad wages are growing around 5%. And they have been for quite a while now. Now, why is 5% too high? Well, I think it's pretty intuitive that you can't have broad wages growing at 5% and expect that consumer price inflation is ever going to come back down to 2%. The math just doesn't work. You can't have companies paying their employees 5% more every year and expect that they're going to charge for their products going out the door less than 5%. So these things are obviously highly interrelated. And I think, just to answer the question more directly, I think that, a lot of those tailwinds coming out of the COVID rebound, the fiscal support, the monetary support, those are proving to have very long-lasting impacts on the economy, right? And even though this year those tailwinds have shifted and are now becoming headwinds, they haven't really had the full impact that we would expect. And that's why I think 2023 is looking so challenging right now.
Right. So the part that I want the audience to understand is, as good as the labor market is right now, we know historically that can change on a dime. Do you agree with that?
I do. Yes. This is one of the big risks out there right now, is that monetary policy in an ideal world is done in a gradual, slow, you get 25 basis point hikes, you wait a couple months, maybe you get another 25 basis point hikes. But what we've been seeing this year has really been, and you've probably heard this term, the Fed being behind the curve. This is, a shorthand way to say they're kind of late to the game. They're trying to catch up. They're tightening policy, raising rates faster than they have in decades. And the reason for that is that largely the inflation forecasts have just been complete garbage. We all remember last year, it was all this discussion about transitory. We fortunately eventually abandoned that and realized that this is not a transitory problem. It's a much stickier, persistent problem that needs to be dealt with. And And the result of that is that policy has turned, and let's recall that, yeah, we started in March with our first hike, but then by June, we had increased the size of those hikes from 25 basis points, so a quarter of a percentage points, to 75 basis points, so 3/4 of a percentage point. And now we've seen 4 of those. So this is a lot of tightening in a very short period of time. And at the same time, we really haven't seen sort of that looseness that we're looking for in the labor market. And this is really what makes the outlook more risky, because I think, just as you said, when the labor market starts to crack, when you start to see the unemployment rate rise, that's a variable that's very difficult to stop. It's difficult to. There's actually an economics rule out there that basically says anytime you get a more than 0.5% increase in the unemployment rate, it's almost inevitable that you're going to see a much larger increase, and then ultimately you'll be in a recession. Now, fortunately, the sample size here is relatively small, so it's not impossible. And if you look at what Fed officials are arguing, they will say that the extreme tightness of the labor market makes this kind of a unique environment where they can achieve a much tighter financial conditions without having the labor market crack. So we can talk about sort of how do you crack the labor market without cracking the labor market.
Yeah.
If that's
I think that'd be an interesting idea. I mean, but the other part I wanted, and this would be your personal view. So you think about the Fed, and they have tons of resources, and they obviously got this wrong, and they've gotten stuff like this wrong in the past. We know that as investors.
Yeah.
You can't depend on what the Fed is saying forecasting wise, or what they're doing, et cetera. So for me, when you think about what the Fed is embarking on with raising the Fed funds rate, we know that the problem with doing that is it's going to cost them more money in terms of interest on the debt that we have as a country, right? So call it $30 trillion in debt. So those payments can rise to $1 trillion if we get to 5% or greater in terms of Fed funds rate. Yeah. So it's either like you let the Treasury blow up, or you let or you try to stop inflation. Which one do you really?
Well, I mean,
so what is your view on that in terms of what you think they could possibly be thinking about as regards?
Well, I think the Fed's answer to that would be that they are not in control of fiscal policy. That the Fed's mandate is maximum employment, price stability, and actually the third one, if you want to throw it in there, is a low and stable interest rate environment. But people only focus on the first two because the third sort of flows from the first two. And I think, they would argue that the medicine right now of getting interest rates high is the cost, if you will, to get inflation back under control sooner rather than later. Because this is a problem that, if it lingers, if it's not tackled aggressively, can drag on for multiple years. And we've seen this before, right? The period 1970s leading up to the Volcker period in the 1980s was a period that, historians, monetary policy historians basically described as a failure, because there was this start, stop approach to trying to get inflation under control that ultimately failed and resulted in inflation that is much higher than we are currently experiencing right now in the early 80s. And that took a Paul Volcker Fed that had to go to extreme levels, had to push the economy into not one, but 2 recessions to ultimately get inflation back under control. So this is one reason that Chair Powell today is invoking Paul Volcker quite a bit in his speeches, because it's this idea, this concept that they'd rather take a bit of pain and be very confident that inflation is under control, particularly with inflation expectations as well, rather than sort of do half measures and drag this out over multiple years and potentially make it more costly. So, getting back to the fiscal question, yes, there's going to, this is going to make debt ceiling negotiations more complex, to say the least. I think we'll see kind of how much that is used as a tactic in a divided Congress next year. But even if they do raise the ceiling, which is more than likely the outcome, despite all the brouhaha that comes with it, it doesn't really solve the problem that we are entering an environment where interest rates are likely to be higher, inflation is likely to be higher compared to the previous decades, and that's going to have real implications on the size and amount of spending bills that can get passed, as well as tax cuts. So I think we're entering not just a new regime for markets, but also in terms of what we should expect out of Washington, because I think particularly around debt ceiling negotiations, it's not as easy, shall we say, as it was even back in 2011, which is when we had sort of the last debacle in the debt ceiling negotiations.
And when you think about today's environment, right, we think about like what we want as investors, right? We really want obviously inflation to get under control. And when we think about where we are with inflation and we're in the job market that's very tight, which means consumers have the ability to continue to spend, which it means that it's going to be hard to really bring inflation down if you continue to have this demand. The difference between the Volcker years and today is that inflation's not ingrained into the economy yet, right? When Volcker took over, it was already for years ingrained into the economy. So one would hope that what the Fed is doing is going to crush inflation. But my question is more about, as you think about the next 12 months, 24 months, even 36 months, is it possible inflation can linger at 4 to 5%? Yeah, we came down from its peak, great. And everybody keeps talking about peak. Who cares about peak? I'm more about where's inflation going to settle in at? And settling in at 4 to 5% is problematic.
It is. No, I completely agree. I think, Chair Powell understands this as well. And maybe, I'll take an optimistic spin to your question, which is
we need that as much as possible.
The optimistic spin is that in terms of inflation expectations, which play a large role in actually price setting today, what we've seen is that those expectations have been largely anchored. Now, part of this might be the fact that we have an inflation target now. So 2% is the Fed's target. Back in the Volcker period, there was no target inflation rate. So in some ways, not having sort of that anchor was probably a disadvantage for the Volcker period, whereas now it's an advantage for Chair Powell. But this is something that they are keenly aware of. If you actually go back to the June hike, when we first saw the 75 basis points, that was a very late in the game decision. It was only about a few days before that meeting where everyone expected 50 and then they increased it to 75. And that was largely because we had inflation expectation numbers come in that were much higher than expected. And there was concern that, okay, maybe we need to really, get on top of this now. Why wait? Let's go with a mega hike that's going to have a bit of a shock and awe aspect to it. Now, this has been, the biggest, market uncertainty, drag on performance this year has really been around where the peak in the Fed fund rate is going to be. So the terminal rate is how most people refer to it. Back in June, if you look at how the market was pricing, expectations were for the Fed funds rate to get to about 3% by early next year, which is still a pretty aggressive hiking cycle. But fast forward to today, now it's north of 5%, right? So we've added more than 2 whole percent just since June, which tells you how bad the inflation reports have been. Now, they haven't all been bad. There's been a couple where it seems like price pressures are coming off, but the last 2 have been bad. We get another one tomorrow, which is expected to be sort of a moderately better report. But unfortunately, we've been continually surprised by hotter than expected reports. And as a result of that, the Fed has had to continually sort of double down on the hawkishness, the aggressiveness. And that has really been weighing on these markets, not just equities, but also, your fixed income portfolio as well.
So Jake, with all your knowledge and experience, bottom line, does the Fed achieve his goal of bringing inflation down?
They do. I think that it might be more painful than all of us would hope, meaning that it's very likely that a mild recession is going to be a necessary evil to get inflation under control. But fortunately, what history has shown us is that to get large deflation periods, oftentimes you need aggregate demand GDP to contract. So that's a recession. So as unemployment rises, very intuitively, people start to tighten their purse strings. Wage pressures come off. You sort of aggregate these things to the economy-wide level. This is how you cool an economy, right? If you think about an overheating economy being associated with prices pressures being too strong, with prices rising too fast, how do you cool an economy? Well, you put it in reverse, and that means you have to go through some pain. Likely, the unemployment rate does need to increase. Now, hopefully, the Fed is in a position to, I don't like using the word pivot, but is able to stop the tightening relatively early and not drive the economy into a deep recession. So and there's a lot of reasons to expect that this recession is going to be sort of a more mild variety. We're not seeing sort of those systemic issues, the leverage issues that would be more associated with a structural recession that takes much longer to unwind.
Right.
This is much more likely to be sort of a, as I've said, garden variety cyclical recession that hopefully we can get through relatively quickly, but also will, I think, solve the inflation problem. So I do think that we're going to get back down to, call 2 to 3% range. And the Fed is going to be comfortable that, getting to that, call it 3%. We don't need to go right down to 2%. And the Fed definitely doesn't want to go below 2%. I think they'll be able to call victory when they see sequential CPI prints next year, especially if the economy is contracting and unemployment is increasing. They'll be able to say, look, inflation is no longer the primary concern. Now we can start focusing on the other half of our dual mandate and begin supporting the economy. So that's why right now, yes, the outlook for risk assets is very challenging, but I think history has shown us that, being a long-term investor, staying the course pays off. And I certainly think there's a possibility that, by the end of next year, we're in a much more optimistic rebound mode.
Why do you believe that some people out there looking at the consumer when they go to a restaurant, when they travel, they feel like we're not in a recession? Why do people keep talking about us going into a recession? What do you say to those people in the most simplistic, quickest form?
Sure. So just to be clear, the question is, why are we going into a recession when activity seems like it's so strong?
Correct.
Yeah. Well, unfortunately, activity being so strong is part of the problem, right? Inflation is a byproduct of that robust overheating economy. And we've already talked about how tight the labor market is, that sort of optimism coming from people's ability to change jobs and ask for higher wages. That is a key underlying issue for getting inflation back under control. And just to sort of put it in chronological order, when we were coming out of COVID, it was much more of a supply side issue. So we know we had supply chain issues. We had excessive goods demand from people being locked down in their homes. Well, a lot of that supply side pressure on prices has now reversed. So supply chains are healing. We're seeing the costs for things like, trans-Pacific shipment. So how much does it cost to buy a ship and get things shipped from China? All of those costs have really started to re-normalize. But now what has happened this year has been that the demand side has really picked up, and much more aggressively than economists were forecasting. And that's why when Chair Powell and the Fed and others were saying that inflation was transitory last year, they were really hoping that those supply side issues would abate and we'd get back to a more normal economy. Right. What they underestimated was how much fiscal support as well as monetary policy accommodation was going to provide a push to aggregate demand in this year, in 2022. And now they're having to say, okay, well, now we have to reverse course and we have to do so even more aggressively to get things back under control.
And last question for you, Jake. In terms of where we are as an economy, right? So we know that quantitative easing was something that was new. QT is currently what the Fed is embarking on. And the quantity of debt we have relative to GDP is some of the highest that we've ever seen as a country, right? The good thing is we're probably the best house on the worst block. And I get all that. So being that a lot of this stuff is new, I mean, how do we really get back to normalization? Do you think we'll get back to normalization as an economy? Do we need a major collapse for that to happen and to rebuild?
Yeah.
That's for me, I struggle with a lot as I think about the future. I do believe as a country, we're the most creative, innovative country in the world, some of the best entrepreneurs in the world. Think about our companies like Google and Apple and Microsoft and Tesla, right? Some of the best companies in the world and et cetera. And I believe that's what helps us to continue to move forward and be the best out there relative to other countries. But this part does concern me. So what are your thoughts?
Yeah. Well, that's a big question.
It is a big question.
So I'll give you a few thoughts. I won't give you the white paper research answer. But I think, my first sort of instinct was actually when you said get back to normal, I actually thought, well, was the decade running up to COVID, was that normal? I think that's one of the big questions, right? We lived through a period that sort of in the research we call the Great Moderation, right? Was a period where globalization, increasing trade, reducing barriers to trade globally was a drag on prices. So we had very low inflation. At the same time that we were recovering from a global financial crisis, so monetary policy as well as fiscal policy for most of that period were very accommodative. And that was great for risk assets, right? Now, was that period normal? It's hard to say. I mean, I think if you look at sort of a long run trend of yields, it sort of lines up that yields were falling for decades and decades and decades. Now we're entering a period where potentially interest rates, yields are going to be at a higher average level for longer. So are we in a new regime? Are we getting back to normal? It's probably a bit of both, as always the unsatisfying answer is. But I think I would point out just a couple of things. Number one is that globalization as a theme, as a trend, seems to have kind of maybe not completely run its course, but definitely is slowing, right? There are more headwinds to globalization. On the whole, that means there's going to be more frictions in the global economy. That probably means that prices are going to be higher. From a demographic standpoint, you have some interesting things going on there as well that potentially are going to result in a different balance of the supply of assets and the demand for assets as globally economies age. And all of these things are going to feed into, I think, a market dynamic that's just going to be a bit different than it was over the last decade. And I don't think we should be too pessimistic about that, to be honest. I think that it's going to offer up a lot of opportunities, particularly to discerning investors that can take a long-term view and find those high quality assets, strong cash flows. Because I think the major theme over the last 10 years when rates were very, very low, markets only went up, was that, it was pretty easy, buy long and just set it and forget it, if you will. I think there's going to be more selective opportunities on a go forward basis because of the way the regime has changed. We're not in that period anymore where interest rates are going to be at zero. We're not in a period where fiscal policy is going to be always, the next big spending bill coming. So I think the optimistic view of that is that that's going to present opportunities, but it also means there's going to be new challenges for investors over this period as well. And obviously we kind of kicked off this decade with a very unexpected and tragic pandemic, but hopefully, and I definitely want to concur kind of with what you said on sort of U.S. companies, the innovation, the fact that this is an economy. If you look at the stock market going back to the Great Depression and starting in 1929, this is an economy and a market that has been through numerous periods of war, depressions, crises, and being a long-term investor through all of those has always paid off. And the reason it has always paid off is because of the innovativeness of the economy to creatively destroy ideas, have a good idea. Well, can you think of a better idea? Increasing productivity and really growing the pie. So I take an optimistic spin on it. I think if you're a long-term investor, that's definitely the perspective that you need to take. So
Yeah,
still gave you a long-winded answer, but
no, but that's listen, I enjoy it. Hopefully the audience will as well. I'm sure they will. To really summarize everything, and you said it's twice, 3 times, is long-term investor. And that's why it's so important people understand, like we've just pontificated about numerous reasons why the economy is where it is, if inflation is going to be able to get hammered down or not, what this is going to look like as we get out of it, a recession, no recession. And the end of the day, investors, when they come in there, when they start each day, markets open, when there's volatility, volatility creates opportunity. And when you're a long-term investor, because we're in a situation where markets are off its high, 20, 30, 40%, some stocks are off, greater than that.
Yep.
Those are opportunities to be able to say to the long-term investor, hey, great, this is an opportunity. The market is
Yep.
not feeling good today. Let's jump in there, take that opportunity, buy good businesses, good cash flows, be a long-term investor. And that's how you really make money. And that's what our audience should get from this more than anything. Again, it's very interesting to talk about the current environment and what we feel is going to occur and what happened and how we can make it out of this. But in the end, it's all about looking for value. And you find value by uncovering cash flow and, creating that balance, because, risk assets do have volatility and you need to balance that out. And that's really the most important part. I'll let you finish off.
No, I completely agree. I mean, especially during really challenging years for the markets like this year, it's hard not to become very short-sighted and myopic, right? But
Absolutely.
That's really why I try to sort of emphasize just like think about how much the market has been through going back to more almost 100 years, and through all of those periods, the market has risen, and the reason for that is really comes back to that idea that it's a resilient market, and you as an investor are being compensated to take on risk.
That's right.
And
That's
that
right.
risk, sometimes it's going to be painful, sometimes there's going to be volatility, but if you're uncovering value in the right spots, it pays off long term, because that's what you're being compensated for, to take risks.
I concur with you. So this is great, Jake. Thanks so much for your time. I appreciate it.
Happy to do it.
Appreciates it. I look forward to doing it again in the future.
Thank you.
All right. Enjoy.